Today I'm joined by Joe Batarseh, Portfolio Manager at Coutts. We're going to cover markets and portfolios. Firstly, economic and market background. 1 month on after the EU referendum, what do we see? We see signs of robust economy still actually globally, especially in the US and Euroland. Clearly we expect the UK to slow, but the overall message is that the UK will slow but not enough to bring the global economy down. So we're not that surprised to see equity markets and risk markets generally perform well. Turning to an area that's really been impacted, property, we remain positive. Yes, there's been a markdown, yes, there's going to be uncertainty, but that income stream from commercial property in particular, we view as attractive. Okay, so Joe, why don't you tell me a little bit about portfolios, Coutts portfolios, and also your interaction with clients. I'll be fascinated to hear what clients are saying about markets and the Coutts portfolios right now.
Sure. Thank you, Alan. So Coutts portfolios are up between 4 and 6% year to date. And I think it's worth mentioning the positioning that we've had from the beginning of the year. At the beginning of the year, markets were very volatile. The FTSE fell to roughly 5,600 in the middle of February. We held our nerve, however, and we continued to keep cash at very low levels in portfolios. As markets recovered after the middle of February, we began to take profit from those assets and increase the cash levels. So that's one aspect of our positioning that has helped us with our performance. The other aspect of our positioning is the fact that we've got a lot of international exposure within our portfolios. And this has helped us throughout the post-Brexit period as well. The fact that a large part of our portfolios are invested in dollars or euros or yen or other currencies has meant that the translational effect of converting those investments back into sterling has had a positive impact, and clients have been positively surprised so far with performance. Now, in terms of what clients are feeling, and the main concern for clients today is the fact that interest rates are now likely to remain a lot lower for a much longer period. And so clients are wondering, how do we try and mitigate the effects of inflation? We saw CPI rise from 0.3 to 0.5%. Now, Alan, perhaps you can also give us an indication of what's available to clients who do have that sort of concern and are risk averse.
It's very tough for clients who traditionally save via cash. It's really not an option here. And our message is that they should look to invest. Now, maybe the first stage of investing may be a more defensive-orientated portfolios. You've got a couple of defensive-orientated portfolios. You mentioned performance of 4 to 6. Does that include even defensive portfolios?
Yes, it does.
So defensive portfolios continue to work well. Well, let's just think of that. If you're earning 4%, that's 8 years of 0% returns, well, close to 0% returns. You may get 0.25% to 0.5% on cash. So it shows the power of being invested even in defensive mandates. So our message would be, definitively, cash is the worst investment once you extend your time horizon, and clients should look to, if they're cautious, at least in the first instance, the defensive mandates. What's inside the defensive mandates? Is it just bonds?
So it's worth highlighting we have 3 main mandates: defensive, balance, and growth. And the key difference between them is the exposure between bonds and equities. So a defensive mandate will have a lot more exposure to bonds. Exposure to equities is roughly 22%. So clients who haven't invested because they are concerned about the type of risk associated with equities, we do diversify away from that and seek assets that are less volatile and generally provide a greater degree of income.
Thank you, Joe. You made some excellent points there. Should be remembered that investing is not for everyone. So please speak to your wealth manager and make sure even a defensive portfolio, is it suitable for you?